Hello. I hope you guys are having a wonderful evening today. And well, the intention of this video is to bring value to you and kind of educate you as to where we need to be at with regards to our finance. Okay. So now, before I begin, I want to give a little bit of my history. My name is Norma Reeves. I'm a life insurance agent. I'm a single mother of 3. Their ages 21, 25, and 27. Those are my children. Right? Now, we come from very humble beginnings. I the type of person that like to finish what I start, and no matter how long it takes, I just work at it until it's done. That's just me. I'm a go-getter. So, that being said, I was introduced to the life insurance industry by my sibling, who is now my marketing director. The power of 1 plus 1. So I was introduced to her by to the world of life insurance, and what's cute is that we all started having no idea, no inclination, because for the colored skin population, or let's just not be so ignorant about it. Just for those of us who don't know, we just don't know. So I was from that side of the world. Didn't know anything about money. Still learning, but have grown tremendously when it comes to that. And I have to say, the privilege goes and the blessings goes to God Almighty, and of course my gratitude and my appreciation goes to my sibling, who decided to take me under her wing and say, hey, let me bring her in and let me show her what this is about. So yes, kudos to my sibling. And now I have the financial literacy to know just where I need to be. And now I'm learning personal development so I can remain and have that consistency and that discipline that is necessary in order to thrive financially. Yes and yes. So for those of you who want to know more, and those of you who want to get on the other side of finance, not be stricken by worries and panics, because it does happen, and living day to day, paycheck to paycheck, thinking that the only way to have money is to work for the man, which could be a woman, from 9 to 5, and just only earn a fraction of what your work is valued. So you may be making $25, $50, $40 an hour. That's how much your boss is paying you. However, your boss is receiving from you for your work $100, $150, $125 an hour. Yes, fun fact. And I'm speaking to this from the experience of being a therapist that was working per diem, or pay as you go. And yes, I was receiving just a fraction of the money that Medicare and Medicaid was paying to my clients for their service. Just fun fact, you know? All right, so now let's get right on into this. I want to talk to you today about the 4 homes of money. All right, so I'm going to write it out, make it a little bit more clear. 4 homes of money. Okay. Now, we all know we have money, and we all know there are several places, or many places, where we can keep our money. All right. Now, for the sake of this presentation, I will talk to you about the 4 particular homes of money. Now, one quick question. Who recalls the story of the 3 little pigs? You know, with the big bad wolf huffing and puffing and blowing their houses down. Okay, So this right here has a little incline towards it, but in terms of money. So like the little pigs, they tried and tried, and they made their efforts to protect themselves from the big bad wolf by building a straw house. One of the pigs built a straw house. The other pig built a house of sticks and shrubberies. And then the last piggy built a house of stone. Okay, so the first house, we already know how that went. The wolf came and said, look, little pigs, I'm going to give y'all 3 days. And in those 3 days, you better hide and run, because when I get you and when I see you, I'm going to huff and puff and blow your house down. So I'm going to show you just how bad I am. You think you got all the talk now and this and that? No. I'm going to be fair. Build your house, store yourselves in there, because when I come, there's no mercy. But today, you get a, what do you call it? A temporary stay of execution. So then the pigs, they go, first piggy, straw house. Second piggy, of wood. And then the third piggy, of bricks. So I mentioned the straw house. He came, huffed, puffed, gone. So what does that piggy do? He runs to his sibling's house built of straws. So then Piggy says, the piggy said, you can't get us, you little mean wolf. You big, terrible, bad wolf. You're not going to get us. So he doesn't. But then he says, oh, yeah? I'm going to show you something. So then he goes away because he's all tired out. And he comes back even stronger. He huffs and puffs and huffs and puffs, and whoosh, blows the house down. First, the wood stayed strong, but then before you know it, the nails started seeping out of the windows. The nails started seeping out from the hinges. The doorknobs started to rattle, and still hinge, in place for 5 seconds. Then before you know it, boom! He knocks the windows out. He knocks the doors out, and then that foundation came crumbling down. And before you know it, the roof collapsed as well. And then the last one, because they got scared, they're like, oh no! They go and run to the brick house. Pause for a minute. Let's start. Now, we're talking about money, by the way. 4 homes of money. Now, in order for us to measure the validity or the stability of money, the first thing that we have 4 areas that we look for in order to determine its strength. So the first one is liquidity. Okay, we want to make sure this house has liquidity. We don't want it to be like a straw house. We want to make sure it has liquidity. And then the next thing is it safe? We're looking for safety. If that money is in the wood house, will it come crumbling down? That's what we want to know. Okay, and then the next one is return of rate. So we go rate of return. I will explain that to you more as to what that really means. But for right now, we're just writing it out. Rate of return. Okay? And then lastly, we want to know, is there an advantage? Okay? Tax advantage. Now, I am going to write out the 4 homes that people typically know and where typically your money will be stored, okay? So first of all, these are the validities. We want to test the strength of these homes on the basis of these. Liquidity, safety, rate of return, tax advantage. Okay, so the first home that we know of is where? It starts with a Banks. Banks, correct. Second one, retirement, known as 401k, the IRAs, the TSP, 403bs. And then we have, of course, we all love it, real estate. And the last one is our mystery home. Wouldn't you like to know? You're just gonna have to wait until the end of the presentation, huh? Okay, here we begin. Now, as far as banks, most of us, we like to store our money in banks because of the liquidity factor of it. Now, liquidity, is it like water? Is it like, well, that's close. Fluidity. Now, in the finance industry, fluidity means equal, like how accessible is it? Is it something that I could just go in and take it out like water? You know, fluid. Speaking of fluid, let me take a sip of my tea. Is it like this? Oh, look, fluid. Fluid. See, look, I can drink this tea without any problem. Fluidity. So we're testing it with the banks. For the banks, if I put my money on here, would that big bad wolf be able to come out and take my hard-earned money? Would it? Answer me. Oh, sorry. Oof, I'm getting a little bit dramatic here. The answer is yes. No, the big bad wolf will not be able to take your money away. The answer is safely, as far as we're concerned, yes. For the bank, you could take out your money anyway, anyhow, and as long as you have $25 in your account, you'll be able to take out $25. If you have $2,500, you'll be able to take out $2,500. Now, this was actually the fact up until, I want to say, 2023, where we have the era or the phenomenon known as BRICS, where these are BRICS, five main countries in the entire world decided they had to do something with the invasion of the big bad wolf. No fair. So anyhow, that pretty much put a strain on the banking industry, in the sense that, or I should say the consumer, the hardworking Americans, the hardworking individuals. You don't have to be an American citizen to be working to have a bank account. Although in 2025, pause for applause or laughter or crickets. Anyhow, let's continue. So, yes, up until that point, until 2023, it was becoming a challenge for people to have access to their money right away. And the reason being is because they had to there were holds on people's money if they've had deposits for more than $5,000, $1,000. Some people mentioned about $500 that they've deposited the money, $500 in their account, and you can only have access to $300. They deposit $5,000. These are checks, by the way, check deposits. If it's direct deposits, the still is currency, and is going from one bank to another bank, so it's electric currency. So therefore, it's instantaneous. But that's another story that we could discuss about later on in another presentation. But yes, so you'll have $5,000, and $3,000 will not be available for the next 10 days. 7 days. And this is a fact. This is fact, because I do know of someone who of significance who actually has his own company, and that is a daily battle. That is a weekly battle. That is a monthly struggle, a monthly battle. That you deposit your money in the account. You need it so you could buy, you could do your overheads. And nope, you have to wait. So it's like saying you got to wait to eat. Yes. So currently, liquidity is a fact up to a certain circumstance and depending on the scenario. But for the sake of this presentation, if I have $25, that's the reason why I said $25. If I have $100 and it's $100 available, I am able to take out $100. If it's 10, 20, in the thousands and above, that is a tug of war. But eventually you will be able to get your money within the month's time. So that's still decent time to turn around. Okay. So yes, for the banks, it is liquidity. Safety. Now, that goes back to leading to what I was explaining. If I put my money in the bank and it's $200 and I leave it there, don't come back on, don't touch it for the next 3 months. Nobody touches it either. I don't have anybody pulling out from my account. No banks, no nothing. Then will I be able to have access to it when I return, say 2-3 months down the line, and I want to take out my money? Yes. As long as it's up to $250,000, the bank does secure your money because it's FDIC insured, up to $250,000. So that answer is yes, because again, there is insurance up to $250,000 by the federal bank. Okay, now rate of return. Fun fact: I was just looking into my son. God bless him. The youngest one, he is in the Marines, and he opened up a Navy account because with that Navy account, he's able to, and he opened up one for me. So with that Navy account, he's able to transfer money interchangeably without any interruption. Remember, electronic wire transfer within banks is almost instantaneously, almost maybe like a second or two or a minute or two, depends on the situation, depends on the traffic at that time. So with him, I have a Navy account, and with that Navy account, we're able to also get a savings. Now, he opened one. He requested I open one, but then my ex-husband, he's also a Army veteran, and he also, we also opened an account with him that he requires so that he do the direct deposits. We'll make his we're younger, and I forgot because now they're older, so he ain't paying any more child support, girl. He said, I'm out. I'm gone. You're on your own, biscuit. Caught it. So anyhow, so I have two separate accounts, but they're conjoined now because it's the same bank. But the reason why I'm telling you more details about this is because I was looking closely. I was scrutinizing the accounts for whatever reason. I just was curious because now that my mind is like expanding so much in the area of finances, I'm scrutinizing every little thing in the area of my life that I normally would have just breezed over. There's a 2% interest growth with Navy, but you have to be qualified. So meaning you have to be the dependent of, or you have to be the family, like immediate family member of a military, or armed forces individual. So yes. So I just realized, wait a minute. If I put if I put $20 in my account for savings, then that means 2% of $20. So 2%, 10% of 20 is 2. So then what's 2%? So 10%, 20% of $20 is $4. So then what is 2% of $20? Rub your nickels to get your pennies together. Rub that together. I believe it's no more than 2 dimes. I'll get back to you with that. I'm gonna have to type it. I'm gonna have to calculate it. But there is some growth. So It's very small growth, but it's significant in comparison to the other banks out there. So normally and typically, there is no growth. With other banks, it's 0.01%. Yes. So rate of return, not so good. Even with me, because 2% really. Okay. Now tax advantage. Is there a tax advantage if I keep money in my bank account? No, I am not being taxed, nor will I receive a tax break for having my money in the bank. So the answer for that is just straight up no. We all know you can't claim taxes on your on free money, on free flowing money in your bank account. You have to have a physical connection to it. You have to have a justification as to, hey, I received this money from, and therefore the receipt is a tax, not the fact that I have the money in there. Okay, just a little bit of clarification. All right, moving on next. 401k retirements. These are plans that are tied directly to the stock market. Now, yes. Now, is there liquidity to your 401k? Most would say no. And the reason why is because you cannot access this money until you're 59 and a half years old, because the intention of this is for retirement purposes. So you're pretty much growing a nest egg for your days when you are no longer in employability mode, or you choose not to be employed or be in employability mode. So you're retiring. So for this one, it's no. 59 and a half years old, there's a 10% penalty if you take it out beforehand. Now, I was hearing from the gurus that, Money Smart Man, that there has been some breaks, some tax advantages due to the speculations that we're currently going through in the economy, that certain conditions, certain circumstances will qualify where that will be waived, the 10%. However, the money that you withdraw, there's always 100% taxes to it. So the answer to this question is still no. It is not liquid because they're dinging you for taking out your own money. Okay. All right. So next, safety. Is there any safety to this? Now, remember, I mentioned briefly that 401k and IRAs, these are all tied to the stock market. So when it's up, oh yes, hey, let's have some party. However, there is no safety to it, because you could lose as much as you quickly gain, and in fact, you lose more because you're taking 10 years, 20 years to build up, maybe say $100,000, $50,000, $80,000, and within a matter of seconds, you could lose a third of that money. Unfortunately, some people have lost almost half of their retirement funds through the stock market, especially now in these days, how the stocks are fluctuating in a ridiculous way, that your money's not safe. You could lose all of your retirement overnight. Okay, so the answer to this is no, it is not safe because there's a risk. It's a very high risk. All right, rate of return. The rate of return, yes, because I was just explaining that when the market's up, you could receive a significant rate of return. But when the market is down, you could lose in the negative. So you could have a negative 34% loss, which has been happening very frequently since COVID. All right. And now, tax advantage. There is a tax advantage in the sense that, yes, you are not being taxed on while the money is in the account and is growing. However, when you take money out, you are taxed 100%. Okay, so let's do the current math. So as far as banks, the safety the strength of the money that we're looking for banks, it's 2 out of 4. For the 401k and retirement, it's 3 out of 4, because this is 50-50. 50% yes, 50% no. So it's 1, 2, 3 out of 4 that it is not. Okay, so really it's 1 out of 4. So it's 1, 2, 3. No, sorry. 1 that is yes, it passes the test, and then 1, 2, 3 that it does not. Okay, now real estate. What do we know about real estate? Oh yes, it's good. It's a good nest egg. We could definitely retire and not worry and live in our own homes for many, 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 many years. That may have been a fact in the 70s and 80s, maybe even 90s, but we're in 2025, man. We just came through COVID. We just came through, oh my God, so many changes. But just COVID on itself is just has really shook us to the core. And then let's not forget about the 10 years prior to COVID, the mortgage industry crashed, where people's houses were flopped upside down. A house that was worth 100,000, just even a house worth 100,000, was now at 300,000. And oh, by the way, they added on that extra 200,000 to the value of your house. So that most people were upside down. I was one of those individuals. Where I purchased a little teeny house because I'm just starting out, testing it, seeing what's going on. And my teeny house that was supposed to be affordable all of a sudden became a nightmare. So I went from the value of my house was a luxury car, 50 to 75,000. Yes, that's all I'm paying for my luxury car. 50 to $75,000. And overnight in 2008, that skyrocketed to $150,000. Back then in 2008, that's the 3-bedroom house in a so what neighborhood. Well, I was living in a 2-bedroom, 1-bath townhouse. Yes, and not the 2-story townhouse, the ones that you connect. The connector. What do you call it? The connector dots? Or connector? Yeah. So yeah, it was terrible. It was horrible. I moved in there because of necessity, but then going through the financial turmoil made it so much worse. I'm glad that I'm out of it. That's all I have to say. I'm glad that I'm out of it. So, is there liquidity in real estate? The answer is no, because you cannot access your money that you put into real estate. In fact, with this bad boy, the way that it works is you can only see any form of money if you were to refinance on the house, and there is actually value in that house that you could actually say, okay, well, I want to refinance my house, and oh, the property is worth 700,000, and the refinance, I owe 200,000, and refinance and interest and everything. So yeah, I'm eligible to receive $500,000 back after everything is said and done. Then okay, but you have to have pristine credit, and your property has to be high up. But remember, with the market, the way how it's gone, everything has flopped, flip-flop, fluctuated. So good luck with that. Now, as far as the other part too, is when you sell the house, if there's any value to it, then you also get it back. But by that time, it's no longer yours; it's somebody else's. So yeah. So no, the answer is no. It is not liquid. Is there safety in having this type of property? Yes, there's safety, and no. Why is there safety? Because as long as you're making due on your mortgage payments, and as long as everything else you're paying your taxes, then yeah, the house is yours. But then the flop side is if you're not making payments on that house and you still owe a significant balance on there, and you haven't paid your taxes, then the bank could take it over, and the what do you call it? The state could take possession of your house. So no, it's not safe in that sense. But yes, it is if you are doing your payments. Now, rate of return. Is there any rate of return? It's some say yes, some say no. So even though all of this happened with the stock market in 2009 for the housing industry, some people are saying that they're seeing value and growth in their home depending on the location of where they live. Now, for the other 98% of the population, no. So it's yes and it's no. Okay. So check your zip code. Are you a 90210 or a show strong? So it all just depends. For me, living in Hollywood am I living in Liberty City or am I living in Brown Subs? That's another story that we could talk about later on. Okay, now, tax advantage. Is there a tax advantage with real estate? The answer is yes. When you sell your house, and once it's no longer in your name, you no longer have responsibility. Whether you owe 500,000, whether you owe $1 million, if that property is no longer in your name, then you cease all responsibility as far as taxes, and it literally wipes off of your credit. That I can testify on that. I have my property. I explained to you, slept. I was at 55, and then all of a sudden overnight I was $155,000 that I owed on the house, and I was like, how am I going to get from up under this? I was just starting out. I had 3 young babies and barely making ends meet. I was struggling, and what had to happen happened. And I'm glad that it did. I learned, I've grown, but I'm definitely grateful for the experience because now I can talk about it. You live to talk about your stories. And I saw that debt of $155,000 vanish overnight when I walked away from that property. I was one of those people. I had to walk away from it. I had to walk away. And I was like, so, oh my God, now I no longer own the house. They took the house from me, and it's gonna be like when they repo my car. Yes, I've gone through that a couple of times. They repo my car, so now I have to pay back $3,000. But my God, it's not $3,000. That's $155,000. Oh, they probably sold the house, and then they sold the house for like $75,000. So now I owe half of that. Oh no, this is what I'm thinking to myself. Well, come to find out, I owed zilch. I was like, what? Huh? Yeah, it's tax-free. There's a tax advantage. Okay, now what's this question mark one? This one right here. It's like, there's another home of money? See. Wonder what that is. I'll tell you in a second. But first, let's review the strength of our homes. All right, so banks got 2 out of 1. And 401k has 3 out of 1. And real estate. 2 for 2. And remember, the validity is 4. 4 out of 4. Now, where is it that we know? By the way, all that sound in the background, I'm not flatulating. I'm not flatulent. My chair has a cover, and the cover and the underneath the cover is leather or pleather. So every time I move, you hear. But I promise you, it's not flatulence. It's the friction between the materials and the chair. Okay. So now, where can I put my money where it's liquid, there's safety, there's rate of return, and there's tax advantage? Where? So basically, what this is telling you is that it will check yes for liquidity, yes for safety, Yes, rate of return. Yes, tax advantage. All right. Well, most people are not aware, and most people have not been put privy to this place. However, being in this industry and having the wealth of experience and knowledge that I've been able to develop and build over the years, I do know where that one place is, and that place is called Life Insurance. Okay, so it doesn't matter how much the big bag, the big bad wolf is gonna huff and puff like the house built of bricks and mortar and sand and rocks. It will be untouchable. Hallelujah. Why? Because with life insurance, when structured properly, when given the correct when driven in the correct vehicle, there is liquidity, meaning you're able to access the liquid portion, cash. Yes, you could build cash in life insurance. You could access the liquid portion of that life insurance for retirement, for a leaky roof, for repairing on your car, to put the down payment, to put your kids through school. You're able to take cash out of your life insurance. Safety. Yes, with life insurance, because we do not directly participate in the stock market, we only mimic the gains of the stock market and not the loss. We could literally say it is safe. Whatever money I have in my life insurance stays, because we have a 1% and 0% cap floor. Meaning tomorrow when the stock market tanks, as it's been doing, 30%, 29%, 34%, guess what? Our money does not get interfered with. It does not get tapped into. No, we may not receive any gains, but we don't lose any of our money, that is the idea. Because when you're saving your money and you're working all these years, 10 years, 20 years, 30 years, and you're putting away for your rainy day, for your nest egg, you're saving for your retirement, you're saving for that what if moment, guess what? We want to make sure that our money, our what if money, is there. So we do that by making sure there is safety in there. Rate of return. Remember I was telling you about the mimicking? Well, we have companies that participate in the stock market, such as the S&P 500 and Swiss Bank, just different investors. Disclosure, each policy vary depending on circumstances and depending on the life insurance company. Now, but as far as rate of return, yes, we actually receive compounded interest on a yearly basis based on how the participation is stacked, based on how it is structured from the onset of the policy. So yes, when they do good, we do good. When they do horribly, we don't get impacted. So rate of return is a yes, it's guaranteed that we are able to receive rate of return when the participation is in the positive. The participation of our contributors. Okay, tax advantage. With life insurance, because it is a life insurance policy and is intended for an insurance vehicle in the purpose of life, it is not taxed. We are protected under the tax advantage. Okay, now there are several taxes vehicles out there that protects us from this, and if you want to know more, then you could always call me up and you could message me, and I'll be glad to research that information with you. But for the purpose of this, the answer is yes, there is tax advantage, because we're not taxed for it. We're not taxed for having money and cash built up in our policies. There is a limit that protects us, and there is a funding guideline that also protects us from having to take part or from having to be penalized for having cash and money building and growing in our life insurance. Okay, so this is our presentation, and this concludes it. And for the time being, bye bye. See you later.